that the central banks are not just the most well-funded traders on the planet, they are the most well-informed traders on the planet. And they know the playbook. And they are using the suppression of the Western paper markets to achieve their goal. By allowing the Western commercial banks to suppress the price of gold to make the United States dollar and bond market seem better than it is, they are using that suppression against us. And we are seeing gold not only and silver be accumulated at record levels, but seeing it drained off of the world's exchanges and taking possession, pulling it off of the exchanges, removing counterparty risk. That gold bar in that gentleman's hand is an example of what gold is.
Central bank demand for gold remained robust in the fourth quarter, with an additional 229 tons added to global official reserves. This brought the annual net demand to 1,037 tons, just shy of the record set in 2022 at 1,082 tons. As a result, the global official sector's gold reserves now stand at an estimated 36,700 tons. The sustained momentum of central bank buying, surpassing 1,000 tons for 2 consecutive years, underscores the enduring strength of this trend. Since 2010, central banks have been consistent net buyers, accumulating over 7,800 tons, with more than a quarter acquired in the last 2 years. Notably, China has a history of periodically increasing its reserves without immediate disclosure. The People's Bank of China accumulated 1,448 tons of gold between 2002 and 2019, followed by a reporting hiatus lasting over 2 years before resuming disclosures last fall. Many speculate that China continued to augment its gold holdings off the books during these silent periods. Some analysts, such as Jim Rickards, have suggested that China might possess several thousand tons of gold held in entities like the State Administration for Foreign Exchange, SAFE, which are not included in official reporting channels. Well, it's because gold is regarded as a safe bet, particularly when everything else appears uncertain. Unlike paper money or government bonds, gold retains intrinsic value that remains stable over time. Therefore, when central banks suppress the price of gold, Andy Schectman argues that they are strategically managing Western paper markets to uphold the perception of stability in the U.S. dollar and bond market, thereby concealing underlying vulnerabilities. The 2023 Central Bank Gold Reserve Survey, released by the World Gold Council, supports this sentiment, revealing that 24% of central banks intend to increase their gold reserves in the next 12 months. Furthermore, 71% of surveyed central banks anticipate a rise in global reserve levels over the same period. We will present clips from Andy Schectman's interview with Arcadia Economics. But before we do, if you want more videos like this, please hit the subscribe button and turn on the notification bell for more updates. Thank you, and enjoy the video.
And I want it to be understood that the central banks are not just the most well-funded traders on the planet, they are the most well-informed traders on the planet. And they know the playbook. And they are using the suppression of the Western paper markets to achieve their goals. By allowing the Western commercial banks to suppress the price of gold to make the United States dollar and bond market seem better than it is, they are using that suppression against us. And we are seeing gold not only and silver be accumulated at record levels, but seeing it drained off of the world's exchanges and taking possession, pulling it off of the exchanges, removing counterparty risk. That gold bar in that gentleman's hand is an example of what gold is. It is an asset that is not simultaneously someone else's liability. And when you see governments around the world selling treasuries at record levels and buying gold at record levels, it's of no coincidence. Gold has averaged, when you take the appreciation from 2000 to 2024, it has averaged 7.8% per year, which has outpaced the S&P 500 and has outpaced the bond market tremendously. At the same time, it has no sanction or confiscation risk. It has no counterparty risk. It has no default risk. It has no risk associated with U.S. treasuries, and I think that is a growing trend. These countries are trading with one another right now in their local currencies. They are not settling in U.S. dollars. They are settling in yuan, in rupee, in ruble, in rial, and they are then accumulating gold instead of buying treasuries, because part of the petrodollar deal was you value oil globally in dollars and the excess you put into U.S. treasuries. Well, we are seeing countries like China and Saudi Arabia and Russia and Japan they're all dumping treasuries. And in place of treasuries, they're buying gold at record levels because it does the same thing. It has liquidity, it has global demand, but it has no counterparty risk. And that is something that we are seeing. And the main topic of all of this presentation and of all of the things that I've been screaming about for 4 years is that the world is creeping towards de-dollarization, little by little, by little, by little, by little, by little. The chipping away at the dollar hegemony is happening in real time. And I think it's important to understand when we talk about logarithmic decay, where are we on this graph? Little by little by little by little, we are seeing the chipping away of the social fabric of this country and of the image of this country around the world and of the economic status of this country and of the moral status of this country. And you can see this term fits so many things. Now, the question is, are we able to stop the raft before we get to the falls? And that's a question for your own mind's eye. But this is why we buy gold and silver. It is not to become wealthy. It is because it is wealth. And it has been for 5,000 years. And the most well-informed traders in the world, central banks, are buying it at levels the world has never seen.
There's a buzz surrounding de-dollarization, drawing significant attention as BRICS nations like Russia, China, and India drastically cut down their reliance on the US dollar in trade, marking a clear push towards de-dollarization within the BRICS alliance. In what is certainly a sign of growing BRICS de-dollarization efforts, Russia, China, and India have removed the US dollar from 95% of trade. The ICC reported that Russia's export settlements in either the US dollar or the euro also fell drastically. Specifically, it has fallen from more than 85% in 2021 to just 34% last year. Over the last year, the BRICS Economic Alliance has not been shy about its de-dollarization plans. Indeed, amid increased Western sanctions on Russia, the country shifted its trade focus. Andy emphasizes that these developments are not accidental but deliberate, with countries strategically aligning themselves with BRICS for economic and geopolitical reasons. In a recent statement, the United Arab Emirates, a major oil producer and newly admitted member of BRICS, announced its decision to stop accepting dollars for oil transactions. This decision came just before a UN summit on climate change, indicating a significant shift in global economic dynamics. Andy suggests that these gradual developments are chipping away at the supremacy of the US dollar in international trade and finance. Let's get back to the interview.
I think you will witness a period of time over the next few years where literally those countries that are in the West right now, in the G7, become the distinct minority across the globe. And the one common denominator with every one of these countries that have either been admitted to the BRICS or have formally applied to the BRICS is that they are very, very resource rich, natural resource rich, and or control major shipping lanes. When you talk about the countries that are in the BRICS right now, or that were just admitted, in particular, Egypt and Saudi Arabia and Iran, you are now controlling the majority of the land around and the routes around the Red Sea and the Straits of Hormuz. And when you add into it Ethiopia at the same time, you are literally covering that entire region. And this is not by coincidence. This is by design. When you look at all of the countries here in red, those are that have formally applied to the BRICS here for the next meeting in Russia in 2024, every single one of those countries is either resource rich and or is a strategic country in terms of its proximity to shipping lanes and or transport routes, either on land or on sea. This is not coincidental. This is not by mistake. And I think you will see this continue. So when you see countries like Venezuela, who in and of themselves wouldn't really rattle the West too much, moving to join the BRICS, keep in mind that they hold the largest known oil reserves on the planet. And so these countries that are being admitted, little by little by little by little by little, chipping away at the dollar hegemony, have severe significance when you look at them in a greater picture, in a bigger picture. You can see very quickly that these countries have been invited to or are being considered to join BRICS for a very strategic reason. We talked about Saudi Arabia being open to settling other currencies. They said that settling oil with other currencies, and that was a very provocative statement. This was after they had formally applied to the BRICS. This is after they had formally applied to the Shanghai Cooperation Organization, after they had formally joined the BRICS New Development Bank. All very big moves in and of themselves. But then at the meeting in Davos to say we're open to taking other currencies for oil, well, that's a big deal. But they haven't done it yet, right? I mean, they're trading with China for yuan or selling their oil for yuan and then taking that yuan and converting it into gold immediately on the Shanghai Gold Exchange. They are, in essence, already trading oil for other currencies slightly, but not really officially. But in 2024, the United Arab Emirates, which is the 7th largest producer of oil in the world, a country that just joined BRICS alongside of Saudi Arabia, just made the statement that we're not going to take dollars for oil any longer. And they made this statement 3 days before 200 delegates from around the world came to the United Arab Emirates for a UN summit on climate change, which ironically was presided over by the chairman of the state-owned oil company, United Arab Emirates Oil Company, who told the delegates that, I just want you to know, if we go this route, we're going to send civilization back to the caves. We're just saying. And by the way, we're no longer going to take oil for dollars any longer. So little by little by little by little, we are seeing the chipping away at the dollar hegemony. And after all, that's exactly what Jared Bernstein wants.
Gold, currently trading at $2,030, has the potential to surge by approximately 50% under certain conditions. This includes scenarios such as a significant increase in central banks' precious metal purchases, the onset of stagflation, or a deep global recession. However, the most probable route for gold to reach $3,000 per ounce is through a rapid acceleration of the ongoing but slow-moving trend: de-dollarization among emerging market central banks. This trend could trigger a crisis of confidence in the US dollar, prompting a doubling of central bank gold purchases. This would challenge jewelry consumption, which currently stands as the largest driver of gold demand. What are your thoughts on the future price movement of gold and silver? Share your thoughts in the comment section below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Thanks for watching.